In today's video, we are going to discuss using a high cash value life insurance policy for income in retirement. There are a lot of advantages when it comes to taking income from the cash value of your life insurance policy. However, there's often two main reasons. Think of it as the why people are attracted to cash value life insurance products, particularly for using the cash value as income in retirement. The first is up on the board, tax-free. This is a huge point of attraction, has been for a long time, and it always will be, assuming that the tax laws do not change around cash value life insurance. But number one is tax-free, and then number two, I've got no risk with this product. So I'm specifically discussing whole life insurance. We're going to look at the guarantees here. We're going to look at a variety of assumptions, but the second benefit is that I do have a guaranteed income stream. I've got certainty there, meaning regardless of what happens in the stock market, in the economy, my income is there. I can bank on exactly what I'm going to receive, especially if I look at conservative projections. So when we look at cash value life insurance, specifically for income, the most important thing to do, in my opinion, is to look at conservative numbers. Often where buyer's remorse comes into play, aside from looking at how to maximize the cash value, how to beef up the cash value, which is something we frequently talk about, when it comes to taking money out, it's the exact same thing. Numbers need to be provided that do not just display the best case scenario, meaning based on the company's present dividend interest rate. What does it look like if I look at a conservative dividend? What does it look like if I just look at the guarantees? Am I considering a fixed loan interest rate? Or am I being shown a variable loan interest rate that's being assumed at a very low rate and assuming that that variable loan rate never goes up? It's important to be made aware of the what if rates go up, interest rates on that policy that is. What if the policy doesn't perform as illustrated? Meaning I'm looking at the present dividend, but it does a little bit worse than that, or perhaps does a lot worse. What can I expect? Can I see those numbers up front? Very, very important to do that. So what I want to start with is corporations. How corporations use cash value life insurance, particularly when looking to take income from the policies. So corporations use cash value life insurance for a number of reasons. We've got another video series on that. However, one huge benefit is that companies can create a retirement benefit for their employees. Most often, it's their executives or key members of the company, but they can make this available to everyone at the company that is. So the retirement benefit to the executive, why life insurance is attractive to them, is one, I've got guarantees. The cash value is liquid to the corporation all the way through, but going back to those guarantees, they can have a level of certainty as far as how much they can promise to their executives. Here's the retirement benefit I'm going to pay you. And then the corporation looks at the cash value product saying, okay, based on the guarantees or a conservative dividend, not just what things look like today, but looking at things conservatively, if I put X amount of dollars into these policies for our executives, can we turn around and be able to pay this benefit down the road? I don't have to come up with extra money out of pocket or not be able to deliver on my promise, especially since these are often put in a contract and they have a promise to pay their retirement benefit. So they have to pay it. To summarize, expectations are going to be set properly from the corporation to their executives and employees. And they want certainty as far as how much income, retirement income, they can actually offer to their executives, assuming these executives meet the vesting period and all the other benefits that come with these plans. So we're not talking about corporations today. I use this as the starting point because if you're looking at a cash value life insurance policy and you're interested in using it for income in retirement, this model is successful and proven, meaning the vetting process. What will they look at? What questions do corporations ask? What are they shown? In order to set expectations properly, we want to go through the same process. So what corporations look at here, the process I should say, is number one, numbers are shown. And often before even meeting with the corporation, they'll request to see numbers. They don't want to waste time with having a discussion about what the concept looks like or anything like that. It's like, show me the numbers first, and if I'm interested, then we can have a meeting. So You don't want to just lead with the best numbers only here. That's a mistake that's sometimes made. Meaning when we work with a corporation, we're not going to show just the best looking numbers to say, hey, my numbers look the best. Hopefully you'll work with me because of that. This is where people run into a trap. So we want to show the best numbers, what it could potentially deliver. But by the way, here's what it's delivered historically. And then if we look at things even more conservative, here's what the numbers look like. Very, very important to do that. And we're going to do that today. We'll have some fun with it. So the goal before looking to actually take income from the policy is to maximize the cash value. The cash value in itself is a safe, liquid, and tax-free area to position money. Those are your core benefits around the cash value. Now, a key here in order to actually maximize the cash value comes down to those two factors, policy design and company selection. Policy design, how low can I go in the base premium? And then company selection, typically the 4 major mutual companies. We've seen them consistently deliver the strongest actual, not projected, actual results. That's why I'm such a big fan of them. So what we will look at here, we are going to review the following. We're going to look at a policy on a 50-year-old individual. He's funding the policy for 10 years, $100,000 per year. So we've got a clean $1 million going into the policy over 10 years. But what does the policy look like based on the current dividend? We're actually going to look at an assumption that's even more aggressive than that. So I'm going to lead with the best numbers, but then start to drag things back down to reality. So we're going to look at something greater than the current dividend, which is an indexed rider attached to the policy, then the current dividend rate, then a conservative dividend interest rate, and then just the guarantees. And the interesting thing about this is going to be one policy shown with different income assumptions. So this way we can actually see what different crediting rates or different dividend crediting rates, how they actually impact my life insurance policy. And it is so important to see this kind of stuff before committing my money to a policy if I'm interested in the income play down the road. So let's take a look here. A lot of data up here. Before I just jump to this actually, let's go through the design of the policy. So this is a growth example. Whenever we look at income, what I always like to look at first is the overall design of the policy. Is it set up for maximum cash value? This way, when I go to look at income, I can directly compare the income model with the growth model and know, okay, everything's set up properly and there's no tricks or anything that I found out after the fact. Wait a minute, I didn't ask enough questions about design and maximum cash value growth. If I would have asked those questions first, that could have generated me another $20,000 to $30,000 per year in income. So let's take a look at the actual design of the policy here. One of the major mutuals. There we go. And what we're going to look at here is as follows. First and foremost, the design of the policy. Where is the money going? So we've got $100K per year going in. Always start with this. Here's your premium. $10,000, 10% of the total desired payment of $100,000 per year. With this particular company, we can go a little bit lower than 10%. It's about 9.1. I just rounded it off at 10 in this example. So you've got 10% toward the premium. There's a term insurance rider here as well. There's the first year cost of it. Purpose of the term insurance rider, there's the term rider amount, is mainly to prevent a MEC. It also, with some insurance companies, and Guardian in this example, allows you to continuously stuff 10 times the base premium into PUAs each year, as long as that term rider is attached. So you'll see we timed it where it's on for a maximum of 10 years, and then it's all but gone. It naturally expires at that point in time. So base premium, $10,000, term rider, about $1,350, and then we've got our paid up additions rider, PUA. Here we see it here. It's listed as scheduled. That can be unscheduled if this individual wants flexibility, which is very common, where one says, let me commit just to the base premium and term rider, and then at my leisure, I'll add more funds into an unscheduled PUA payment. So, as we look at this guy here, and keep in mind, I said we're going to lead with the best, and then gradually drag things back down. I'm not doing that to beat up the product that our company sells. It's just to properly set expectations. So important here. So when I say lead with the best, we've got this indexed participation feature attached, which allows us to tie our cash value to the S&P 500 index. It's still a whole life insurance product where I've got a guaranteed rate that exceeds the cost of insurance, and I can flip back and forth between the indexed rider and the basic dividend. I can go 50-50. I can have a lot of fun with that. We've got a couple videos on that. Just type in indexed on our channel or index, and you'll see it pop up. So here's your payment, $100K in the first year. There's your cash value, 83.4% right off the bat. First year death benefit, $2.3 million. What you'll notice is that death benefit stays level, but look at the column to the left, the net cash value. That term rider is decreasing as your whole life death benefit is increasing. So you've got a whole life death benefit that is increasing as we're stuffing our cash value here, and then your term just decreases proportionately. That's an extra detail that some people enjoy. Some people say, who cares? But as we look at this, here's your break-even point. It's really year 5 in this example. At this point in time, you've paid in a total of $500,000. You see right here in your cumulative net after-tax outlay column, your total payments, you've paid in 5, and you have more than $500,000. By year 10, you've paid in $1 million. You've got just about 1.2. And then this example displays what the policy looks like if you just let it sit and grow. Now, we're going to look at income. So the purpose of leading with this, because when we look at the exact same policy, here we go. Everything's identical on this. Indexed rider, 10K base premium, identical term cost. You'll even notice the first 10 years, first 15 years actually, of cash value and death benefit values are identical because it's the exact same illustration. The difference is this guy. We've got income coming out now. So I want to capture those top columns because I want to point out something before we go to the Excel sheet. Is here, what we've got, there's your payments of $100K per year. Look at this column, your total payments, $1 million. Next 5 years in this example, we don't do anything. We can access that cash value all the way through, but here we don't do anything, and we start to take income out at age 65. Now, at age 65, you'll see here, $89.5 per year coming out. These are tax-free distributions. What we're doing here is taking policy withdrawals first. We're going to take withdrawals up to our cost basis. That's our total payments of $1 million. And then we begin to take out loans without paying anything back. But here's what I want to hit on, or direct your attention to, I should say. Look at your cost basis here. It was $1 million. Now it starts to go down because we're pulling money from the policy. I paid $1 million in. Can I get more out than I paid in? And the answer should always be yes if everything's set up properly. Another thing I want to hit on here, come on. There we go. Make that a click bigger. So you're taking those payments out. What do you notice about that loan column? Annual loan or cumulative loan, which is our loan balance. When you start the income at 65 of $89.5 per year, there's no loans. If you ever see that on an illustration, that's an indicator that those are pure withdrawals. Now, you'll notice that the withdrawals continue until, look at this column, cumulative net after-tax outlay. You hit your cost basis. Once that goes negative, which represents you've pulled out more money than what you've paid in, we flip over to loans. The income amount we are still pulling each year is $89.5. And again, why we flip it to loans is to prevent the taxable event. If we withdraw more than what we pay in, taxes will be due as ordinary income. And that's with a non-MEC policy, by the way. So we ran income in this example up until age 95, so for a long time. We could go longer, and we solved all of the policy options not to lapse at any point in time. So again, this is best case scenario. But then as we look at the same policy and begin to look at different assumptions, such as this, now we see same policy, guaranteed values, current dividend values, and then intermediate, which represents a conservative dividend. And this is an income sample, where actually we had to adjust this for each assumption. So we're going to jump to the Excel now, which we exported all of the data from the illustrations to Excel, and let's have some fun, shall we? All right, so what we will begin with here is an assumption or a sample of the growth models. So again, same policy here. If we start with the example on the far right, going backwards, that's that indexed rider. This is the illustration we just looked at, and you can tell here, there's your year 5 cash value, 503,880. There's the year 10 cash value, just under 1.2 million, the $1,186,000. Now, scrolling your eyes to the left, you've got the company's present dividend interest rate at 5.65%. Do you notice a difference in the values? If we just look at this side of the screen, look at year 5, 496 and change. Indexed rider, 503. If the dividend holds steady forever and no insurance expenses adjust with the insurance company, that's what I can expect. Things do adjust, and they will adjust. Indexed rider is extremely unpredictable because who knows what's going to happen with the S&P 500. You've got a present cap rate of 11% there. With that rider, I like attaching it. We'll often leave it at 0% and then flip it on when the policyholder wants to. There are some things to be aware of with fees. There's a fee on the years I exercise it. And again, we've got a separate video on that, or videos, I should say. But that's the present dividend rate. And what's often shown to individuals is this, and sometimes that, maybe these two. Now, when we start to look at income, what's beneficial to be aware of or to see are more conservative scenarios, meaning I want to set expectations properly so I know how much income I can pull from the policy. Conservative dividend, just over 4.3%, and then the guaranteed rate with this product is at 3%. And look at the difference in growth before we even look at the income models. Break-even points. Conservative dividend, just about year 7. And then the guarantees, year 11. So I like to start with those. So as we look at the income next, we're going to see what it looks like when I compare the growth illustrations directly with the income illustrations. So let's have some fun. We will begin with the indexed option. This is the illustration we looked at. We mentioned we're going to start with the best and then drag it back down to reality. So growth model on the left, income model on the right. Remember that income dollar amount was the 89.5. What is in black, that column, represents your total payments. So you've paid in $1 million, 100,000 over 10 years. Now, if you're taking 89.5 per year, there's the actual distributions. By age 75, you've taken your $1 million out, approximately. 76, continue to pull out the 89.5 each year. And what this means, when you see this in the red, is you've now pulled out $1 million, and now you're getting more back than what you've paid in. And you still have cash value, and you still have a death benefit that is paid to your beneficiaries income tax-free. As we continue to scroll down here, what do things look like over time? If we kick the bucket at 90, death benefits just under $1 million. You've pulled out the original $1 million you've paid in, plus another 1.3 and a quarter. So you've gotten a lot more back than what you've paid in. Keep in mind, this is best case, or close to best case. We can make this look a little bit better if we wanted to, but I don't think we should do that. Fine to look at, but then setting expectations properly. Here's the present dividend interest rate. So standard projections, typically what we're shown here. On the left, you've got the growth model. On the right, same thing for the first 15 years. Then what do you notice? The maximum income we can illustrate is not 89.5. In fact, if we do that, the policy will lapse well before age 95. We'll be forced to pay in more, we'll have to stop taking income early. Doesn't work. Quick side note too. A lot of people we work with, when they're looking at income samples or they're planning on taking income from the policy, some like the idea of a level income stream. Most don't plan on that. Most have other income producing assets that here's my income in retirement, and as I need or as I want additional income, I'll just dip into this. Some years I'll take more than 70, some years will be less. Completely up to them. You don't have to just flip an income switch on. You can request each year, every month if you want, as frequently as you'd like. Here's how much I'd like to withdraw or loan against the policy when we're looking at the income sample or income scenario. So here we go. When do you hit cost basis? Age 78, meaning you've got your million back at 73.5 per year. Continue to scroll down. There you go. By 95, 73.5 per year, 1.2 and a quarter, a little bit more. There's your leftover value. If I die during this process, let's say at age 87, remaining death benefit is about $1 million that's paid income tax-free to my beneficiaries. All the meanwhile, I'm getting income out. So this still looks good at the 73.5. However, let's look at things a bit more conservative now. So this conservative dividend, so in the industry, if you're ever making a request to your agent, it's referred to as a midpoint dividend. Remember working with someone, we set his policy up over a year ago, and he's in the industry actually, and when we were finalizing everything, we looked at growth scenarios, we looked at income scenarios. He asked, can you show me the internal rate of return? We also looked at income projections based on the current dividend, a midpoint dividend, and also the guarantees. He wanted to see everything. We looked at historical performance, all of that fun stuff, but he wanted to see it because he knew what to look for. He knew what questions to ask. Imagine if you had someone like that advising you, make sure you ask this question because this is what sometimes is missed. That's the important piece right there, or one of the many important pieces. So, conservative dividend. This is something that I like looking at. I'd peg the actual, for a realistic projection, just where things are right now, probably somewhere between the conservative dividend and the current dividend rate, the last projection we looked at. But again, this is a long horizon we're looking at, so this is where we track the performance on a regular basis and keep everyone up to speed. But seeing different projections up front goes a long, long way. So here, age 65, start the income, $55K per year. Continue to take distributions, there we go. $55,000 per year. And then at age 83, have to flip over to loans. And we can tell because this goes into the red. The illustration, you'll start to see a loan column or an annual loan each year once we exceed the cost basis. When I say on the illustration from the insurance carrier, $55K per year, and same thing. So I rounded all these numbers down just to have, at age 95, approximately 150 or so, somewhere a little bit more in cash value, a little over 200 grand in death benefit that's paid tax-free to my beneficiary, and we drained this thing as well. So here's a conservative illustration. It's a dividend of 4.3%, a little bit higher. That's quite conservative, even for today. So this would assume that the dividend rate today is 4.3%, which is higher than that, but it would assume it's a 4.3 and it never fluctuates. So if it starts higher, goes down, comes back up over time, that's going to have an impact. This is, in my opinion, conservative, just based on history and experience and data. But what this shows here, paid in $1 million, got your $1 million back, and then another $720,000, all tax-free because it's a non-MEC and we took withdrawals up to cost basis, then loaned the rest. Now, let's look at the worst case scenario, the thing that everyone wants to hide. I shouldn't say that. Not quick to show. One, because the numbers are not as attractive, and then two, depending on what insurance company or companies we're considering, they don't make the guarantees readily available. Or not easy to present. Sometimes they'll be generated in a 50-page PDF report that's broken up into multiple pages. So when we're trying to make that convenient for the person we're working with, we'll provide that report, right? This way they've got the illustration, it'll be in their full contract as well, but then also export that data to Excel. That takes some time. Let's put it that way. But here, ran 41.5 per year. And you'll see the same trend here, right? 41.5. My question is, with these scenarios, can I still get more money out than what I paid in? And I'm starting at age 50 in this example. If I start earlier, I've got more time for it to compound. Depending on how much you're paying in, that's another story as well. But here we go. Age 95, there you go. We got our million back, plus almost another $300,000. And this assumes the worst case scenario, the guaranteed rates. It also assumes the maximum charge for the term riders and everything else that's attached for the policy. So it's a worst case scenario. And in fact, we can see that right here. So there's the 100K per year. I direct your attention to the guarantees. 41.5. Values will match the Excel sheet. If you're working with or if you've worked with us, you know how this works because we'll provide both. This way we see everything there. So a lot of information there. What we can do, just to summarize, is lay it all side by side here. This way we can just simplify things further. So now again, these are the income scenarios we saw. First we looked at growth side by side with the income. And then here, what do we have? Guarantees, dividend, current dividend, conservative dividends in the middle. And there's the annual income. All right, can I create a source of guarantees when there's market uncertainty? What a lot of people like to do, I'll tell you this, is instead of taking a level income stream, if they've got money in the market, for example, and they're using a life insurance policy as their fixed asset, specifically focusing on the cash value, what they'll do is years or during periods of time, and there's a down market, they'll allow their money just to continue to do what it does, right? They try not to give into the fear, crashed, let me pull it out. Nope. I know the strategy here is just to wait it out there. Very important. Those that aren't actively investing and pulling their money out, putting it back in the market, they'll let that do what it's going to do. And then in a down market, they'll go to their fixed asset, the guaranteed asset, and access cash value to supplement income. So maybe we see something like $200,000 per year in income coming out, no income from the life insurance policy, and then during a period of time, maybe it's 4 or 5 years, we're taking $200,000 per year in income from the life insurance policy while our funds in the market recover. Nice way to balance assets there. But we've seen that strategy. A lot of people do that. It's a nice strategy just to be aware of. So I hope you enjoyed this one. In our next video, we are going to look at a similar scenario, but with a shorter funding period. You're going to see how to beef the cash value up initially a little bit more as well. Also, if you want to access the cash value for things other than just retirement income, which I love talking about. It's really the opportunity. How do I actually invest in my business and real estate and all that other good stuff? But I hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.